Over the last few years, there has been a clear transition in investor interest, moving from traditional dividend stocks and dividend ETFs to these newer covered call ETFs and single stock ETFs. Recent reports have shown that ETF inflows have consistently broken records each year, and in the most recent cycle, the majority of new ETF products being launched have been focused on covered call or single stock strategies. Tens of billions of dollars have poured into these funds as investors chase unusually high dividend yields, sometimes as high as 20%, 40%, or even more. However, while those numbers look incredibly attractive on the surface, these products come with unique risks that many investors fail to fully understand. The high yields are not simply free money. They are part of a structured option strategy that can significantly affect both returns and risk exposure. To understand the growing popularity of these ETFs, one has to consider investor psychology. The market environment over the past few years, with low interest rates, uncertain growth, and market volatility, has led investors to seek alternatives that can provide more consistent income. Many of these covered call ETFs pay dividends monthly or even weekly, which appeals to investors who want income that more closely matches their expenses. After all, household bills don't arrive quarterly, so receiving regular monthly or weekly payments feels more practical and comforting. Another factor driving demand is the convenience of these ETFs. Technically, any investor could replicate the strategy themselves by buying a stock and then selling covered calls against it. But that takes time, effort, and some expertise. For many people, it's easier to simply buy an ETF that does it for them. Within these funds, a professional portfolio manager handles the process of selecting the underlying stocks, selling the call options, rolling over positions, and managing risk. For investors, it's a neat package that delivers income without the complexity of individual option trading. That said, while the structure is appealing, the investor still needs to understand what's happening inside the fund. Each covered call ETF has its own underlying holdings, sometimes a single stock, sometimes a basket of stocks, and its own strategy for selling options. The income generated from selling those options depends heavily on market volatility and the price movements of the underlying assets. When volatility is high and the market experiences larger swings, the premiums collected from selling calls are higher, which in turn boosts the dividend payouts. When volatility falls, those premiums shrink, and so do the payouts. This means that while the income stream from covered call ETFs can appear steady, it is not always consistent. There is a difference between receiving frequent dividends and receiving predictable dividends. Investors might get a payment every month or every week, but the amount will often fluctuate based on market conditions. This can lead to confusion or disappointment when investors expect stable, fixed income and instead receive varying payouts. Still, there are several advantages to covered call ETFs. They provide investors with regular income and simplify what would otherwise be a complicated option strategy. They can also offer some downside protection, as the option premiums collected can offset small declines in the underlying asset's price. However, these funds are not without drawbacks. The main disadvantage is that investors sacrifice potential upside. Because the fund sells call options, its upside potential is capped. If the underlying stock rallies strongly, the ETF will not fully participate in that growth since it is obligated to sell the stock at the call option's strike price. Furthermore, not all covered call ETFs are created equal. Some are designed for investors who prioritize capital preservation, while others target maximum income generation, even if that means eroding the underlying value of the fund over time. For example, certain funds, such as those modeled after the GEPI or GPQ style of ETFs, aim to balance income with the protection of the share price. They tend to offer lower yields, perhaps in the range of 10% to 12%, but maintain their net asset value more effectively. In contrast, other funds that promise extremely high yields may do so at the expense of their share price, slowly eroding the investor's capital. A good way to analyze these ETFs is by examining both the price history and dividend history of the fund. Most financial platforms like Yahoo Finance provide a historical data tab where one can filter for dividend payments and see how they have changed over time. By also looking at the adjusted price, which accounts for dividends, an investor can assess the total return, not just the yield. This helps reveal whether the high yield is truly providing net gains or if it is being offset by a falling share price. When it comes to choosing a suitable yield, the right answer depends on the investor's goals and risk tolerance. For long-term, buy-and-hold investors seeking stability and modest growth, yields in the range of 3% to 6%, or at most 8%, are often ideal. These yields are sustainable and usually come from companies with strong fundamentals. For example, traditional dividend stocks such as those from consumer staples or established utilities may not offer thrilling returns but provide reliability. On the other hand, investors seeking higher income and who are less concerned with short-term price declines might look toward yields of 10% to 15%. These tend to offer more consistent income, though with slightly higher risk. For younger or more aggressive investors who are comfortable with volatility and the possibility of capital erosion, chasing 20% to 30% yields can be tempting. But such levels of income usually come at the cost of share price depreciation or the return of capital, rather than true dividend generation. It's also important to recognize that some portion of the payout from these ETFs might be classified as return of capital, meaning the fund is literally giving back part of the investor's original investment rather than distributing earned income. For those investing primarily for income, it can make sense to reinvest part of those payments back into the ETF to maintain or grow the base investment over time. Another concept investors should understand is NAV erosion, which refers to the gradual decline in a fund's net asset value. This erosion is common among covered call products because part of the income they distribute comes from selling away potential upside gains. While seeing a declining share price might seem alarming, it isn't necessarily a deal breaker if the total return, including dividends, remains positive. For example, some high-yield ETFs may show a negative price return over the past year, but still deliver a positive total return when dividends are factored in. The key is to analyze total performance, not just share price movements. Recent examples demonstrate this concept well. Certain covered call ETFs tracking volatile assets, such as MicroStrategy through the YieldMax MSTY product, have managed to deliver around a 10% total return over the past year, despite the inherent risks. Others, like the YieldMax Ultra High Income ETF, ULTY, have achieved even higher total returns, sometimes around 25% when dividends are included. These numbers show that such products can perform well for the right kind of investor, but they are by no means guaranteed or safe. A crucial distinction to make within the category of covered call ETFs is between those that focus on single stocks and those that track broader indices. Single stock ETFs, which use derivatives to mimic exposure to a specific company while also implementing an options overlay, can be extremely risky. For instance, a fund like MSTY, which indirectly tracks MicroStrategy, a stock heavily correlated with Bitcoin, represents a leveraged bet on a leveraged asset. That kind of double exposure can produce dramatic gains in a bull market, but equally severe losses when the market turns. The reality is that many of these single stock ETFs are relatively new. Most have not existed long enough to be tested through major economic downturns or liquidity crises. Many have been launched after 2020, and none were around during the 2008 financial crisis. That lack of historical performance data makes it hard to evaluate how they might behave under true market stress. Liquidity risk. The possibility that the ETF cannot efficiently buy or sell its derivatives due to frozen markets is a real concern that could surface in a crisis. For this reason, index-based covered call ETFs, such as those built on the S&P 500 or NASDAQ 100, are generally seen as more stable and reliable. They are diversified across many stocks, reducing the impact of any single company's decline. Funds like the GEPI or GPQ have proven more resilient because of that broad diversification. That said, diversification in name alone does not always guarantee true diversification. Some ETFs marketed as diversified may still be concentrated in a handful of volatile sectors, such as technology or cryptocurrency-related assets. These portfolios may move in lockstep when volatility spikes, providing little actual protection. Another emerging trend within this space is the frequency of dividend payments. Traditional dividend-paying stocks and ETFs typically distribute income quarterly. Covered call ETFs, on the other hand, have moved toward monthly distributions, and now even weekly ones. Recently, there has even been talk of funds that could pay twice a week. And with the rise of blockchain and tokenized assets, daily dividend payments may eventually become possible. While that may sound appealing, more frequent distributions often come with higher complexity, greater costs, and increased risk. The more often a fund trades options and handles distributions, the higher its expenses tend to be. This complexity can create potential points of failure that investors may not fully understand. For most investors, the frequency of payments should not be the deciding factor. A simpler way to create regular income is to own several monthly paying ETFs with staggered payout schedules, ensuring consistent cash flow throughout the month without relying on hyper-frequent distributions. Another issue worth addressing is overexposure. Some investors get excited about the high yields offered by covered call ETFs and decide to allocate all or most of their portfolio to them. This is a risky strategy. Putting 100% of one's money into a single strategy, sector, or theme can lead to catastrophic losses when conditions change. It's better to think of covered call ETFs as one component of a diversified portfolio. For most investors, limiting exposure to these products to 10 to 20% of total holdings is a sensible approach. Diversification remains one of the most reliable ways to manage risk. By comparing price charts of different ETFs, investors can observe how they move in relation to each other. Many covered call ETFs are highly correlated, meaning they tend to rise and fall together, so owning several of them may not offer real diversification. Balancing them with traditional dividend stocks, consumer staples, real estate, or bond ETFs can provide a healthier mix of stability and income. Covered call ETFs are not necessarily ideal for beginners. Understanding them properly requires a solid grasp of both ETFs and options trading. Investors must know how the underlying assets behave, how the fund's managers implement the option strategy, and what kind of market outlook suits that strategy. Without that foundation, it's easy to misunderstand the risks. Many beginners get drawn in by the promise of high dividends without realizing how those payouts are generated or how vulnerable the fund might be to market declines. Investing doesn't need to be overly complicated. While financial media and online personalities often highlight complex strategies to sound sophisticated, true investing success often lies in simplicity, consistency, and alignment with personal goals. Covered call ETFs can be powerful tools when used properly, but they are not magic solutions. They must be matched carefully to an investor's needs, experience level, and tolerance for volatility. When comparing traditional dividend ETFs with covered call ETFs, the long-term winner depends largely on the investor's priorities. Traditional dividend ETFs, often yielding around 2% to 5%, typically focus on companies with strong balance sheets and consistent dividend growth. These dividends may start lower, but they tend to increase year after year, providing long-term compounding income and capital appreciation. Covered call ETFs, by contrast, may offer flat or declining income over time and limited growth potential due to the nature of their strategy. They generate higher short-term income, but often sacrifice long-term compounding. For investors in or near retirement who need reliable income now, that trade-off might make sense. For younger investors with longer time horizons, however, traditional dividend growth strategies usually deliver better overall results. In practice, many experienced investors choose to combine both approaches, using covered call ETFs for a portion of their portfolio to generate higher income and traditional dividend ETFs for stability and long-term growth. The key is to strike a balance that aligns with one's objectives, risk tolerance, and investment horizon. Ultimately, covered call ETFs are not inherently good or bad. They are simply tools, instruments designed to serve specific purposes. Their effectiveness depends entirely on how, why, and when they are used. Investors who understand their mechanics, monitor their total returns, and manage their allocation prudently can benefit from them. But those who chase yield without understanding the risks may end up losing more than they gain. The message throughout this discussion is one of awareness and moderation. High yields can be tempting, but they rarely come without trade-offs. Understanding those trade-offs, whether it's limited upside, potential NAV erosion, or exposure to volatility, is what separates smart investors from speculative ones. In the end, the best investment strategy is not the one that promises the highest returns, but the one that fits the investor's personal financial goals, temperament, and long-term vision. Covered call ETFs can play a valuable role in a portfolio, but they should be approached with education, caution, and a clear understanding of what they truly deliver.